Hello viewers, welcome to the Fast Profits Daily. Myself Brijesh Bhatia. Well, markets are roaring higher and higher, and as an investor, you should be thinking: should I book the profits, or what should I do? So there are three possibilities. Either you keep holding your positions and wait in case market dips. If in case markets goes higher and higher and you think that still there is a room into the markets, you hold to your positions and wait for markets going higher and higher. The second option is you sell your positions, book profits, move out of the positions and wait for markets dip to enter a fresh positions when you are on cash. And the third option is hedging. Uh, well, what is hedging? For me, buying an insurance, buying a mediclaim is an hedging because there is a risk of, in case there is an hospital bill uh, of around say 10 lakh rupees and I'm unable to pay. So there is a risk where I buy insurance, and that's called hedging the risk over here. Okay. When you are into the stock market, so there are various ways to hedge the markets. In this video we will be discussing how you could hedge using futures. Okay, so first let's look at a portfolio, a dummy portfolio which I have created of Mr. ABC. So if you look at the screen, there are n number of stocks over here. So there is Ambuja Cement, there is Naukri, Reliance, Indigo, Asian Paints, DLF, Infi, United Spirits. And what I've done is I've taken a buy price of each and every stock. I've taken the beta. I'll share you from where did I got the beta and what is beta. But look at the number of shares and the total investment. So what I've done is I've multiplied the buying price with the quantity to get my investment amount. Now, if you look at the beta, you can see on the screen somewhere 0.92, 0.75, 0.9, 1.21. So what is the meaning of beta and where can you get? Let's understand what is beta first. So beta is a percentage of the move against the benchmark index. So in this case, let's take a benchmark index like Nifty 50. So as you know that Nifty 50 is generally known as the market trend bullish or bearish. So every 1% move of Nifty, so if you look at the Ambuja Cement which is around 0.92, Ambuja Cement moves 0.92%. Similarly, if you look at the DLF, so every 1% move for Nifty, rise or fall, DLF rise or falls by 1.72%. Now, the higher the beta, the volatility is higher in the stock. If you are a high risk trader, high risk investor, you can look for a high beta stocks. Now, the best way to play the beta is when the markets are at lower levels. Look for this high beta stock where you still think that the company is excellent, company can do very well. Okay, low beta generally you can say slightly slow mover against the Nifty. So if you look at some of the over here 0.68, the Infi 0.68, what does it mean? That every 1% move, Infosys move, every 1% move on Nifty, Infosys move by 0.68%. And where can you get? So if you look at the right now, this is a website called Trendline, and again we are not promoting any website in this video, but just to showcase where can you find the beta. So if you look at, you type any quote over any stock over there, so I have circled over there the beta of 1 year. So you can check this beta and you can write in the column against your stock. Okay, so that's the trend line. Okay, coming on to the next, which is very second step, is very important to calculate stock weightage. Now, how to calculate the stock weightage? What I have done is, if you look at the Ambuja Cement total value, okay, which is somewhere around 1,02,900, and if you look at my total investment on the lower panel, 37 lakh 86,400. So I have divided Ambuja Cement of 1,02,900 with 37 lakh 86,400, which gives me around 2.72% of weightage of Ambuja Cement in my portfolio. Similarly, Naukri is around 19%, Reliance is somewhere around 10%. Okay, and I have taken the weightage of my portfolio, total of my investments. Now, next step is calculate weighted beta. What I've done is the beta which we got from that website link Trendline, which is the default one, which is generally 1 year, changes accordingly with the market's momentum, and I have multiplied with my stock weightage of my portfolio. So if you look at the first, I got 0.03, which was 2.72% into 0.92, which is around 0.03, and I've taken some of that weightage, which is 0.86. Okay, this is the third step you have to calculate. The first, your portfolio. Second, your stock weightage. You have to find the beta of your portfolio of each and every stock. Second, you have to do stock weightage. Third is finding the weighted beta over here. Okay, so this is the third step you have to look, and I have mentioned the formula below the table as well in case you get confused on how have I calculated. Okay, now the fourth is most important step you need to understand, the hedge value. And what is the hedge value? Your investment value, which was 37 lakhs, I have multiplied with the weighted beta, which I have got for my portfolio, which was around 0.86. So if you multiply 37 lakh 86,400 into 0.86, it comes to 32 lakh 56,304. This is my hedging value. I repeat, this is my hedging value. Okay, so you got these steps. Now you have got the hedging value. Okay, now we will hedge with the Nifty over here in this hedging strategy. So what I'm doing is, if you hedge your portfolio with Nifty futures, first you need to find Nifty contract value. Say for an example, I've taken a Nifty current market price of 17,500 roughly. Okay, so it might change when you execute any trade. So you need to calculate this contract value. So taken a 50 as a contract size, your contract value is somewhere 8,75,000. Okay. The next step is, if you remember, our hedge value was 32 lakhs 56,000 rupees. Okay. So now you got 50 as a lot size. Okay, for the Nifty. So you can't go into decimal into the futures. So you need to understand what quantity or what lot size you need to trade. Okay. So next step is calculate the lot size. So what we have done is, we have taken 32 lakh 56,000, divided it by 8 lakh 75,000, which is the contract value of the Nifty futures. So we got somewhere around 3.72. So I'm taking roughly higher side is a 4 lots. Okay, I repeat, I'm taking 3.72 as a 4 lots. So some might, if you get, sometimes you get an answer, so around say 3.13, you can consider it as a 3 lots. So which is not a full hedge. It is generally known as under hedge and over hedge. So we are doing over hedge because we got 3.72 and we are doing 4 lots. Okay, so contract value is slightly go higher. Okay, now let's look at if I am doing 4 lots of Nifty, say 17,500. So I am hedging my portfolio of 37 lakhs and shorting Nifty futures 4 contracts, which is 4 lots. Okay, I repeat, to hedge my portfolio, we are shorting Nifty futures 4 lots over here in this example. Okay, so depending upon your portfolio, depending upon the hedge value, you can accordingly hedge your positions in those manners. Okay, sometime it might happen that you might have the mid cap stocks, but you need to keep that beta in mind, and you have to calculate the weighted beta to get the exact number of lots you want to trade. Okay, so now you have taken a hedge positions against the Nifty. So let's take an example. In case on 1st September you have taken a hedge on going short on 17,500, 4 lots of futures of Nifty. Okay, now on 15th September, say for example it went to 16,500, which is 1,000 points lower. Okay, so what profits are you making in Nifty futures? Because you are short over here and market is in your favor in futures, not in your portfolio cash portfolio, but in a futures you are, market is in your favor. So you are making 1,000 into 200 quantity, because we have taken a 4 lots, 550 into 4 is 200, and we made a profit of 2 lakh rupees on this, gross profit of 2 lakh rupees on Nifty futures. At the same time, let's look at how our portfolio performed. So if I look at the 1,000 points fall on Nifty, which is equivalent to 5.74%, 5.71% of fall in Nifty. What I've done, I've taken 1000 divided by 17,500. So it gives you around 5.71% fall in Nifty. Now, if you remember, we have hedged 0.86 weighted beta. So I will multiply 5.71 into 0.86, which comes to around 4.92%. So as per our weighted beta, when Nifty falls 5.71%, which is 1% if Nifty falls, our portfolio will fall by 0.86%. So in this case, 5.71% fall is equal to 4.96%, 4.92% in our portfolio fall. So let's look at the profit you made in Nifty future, which was around 2 lakh rupees. Considering 0.86 as a weighted beta, our portfolio loss was somewhere around 1,86,000. Okay, so still, when your markets have fallen by 5.7%, because you've taken a hedge, you are still making money somewhere around 13,000-14,000 rupees. So you're not into a loss because we have overhedged. If you remember, we got a 3.72 as a lot size, but due to decimals, we can't do in decimals. So that's the reason we have taken 4 lots over here and we have slightly overhedged. And that's the reason you are looking at 13,000, 14,000 as a gain. But sometimes in case you might get 3.99 or 4.01 and you have done 4 lots, you might not see those profits. But yes, your loss has been hedged over here. So you're not making loss when you are hedging your positions. Okay, so you need to remember this. And sometimes it might happen that in case you are having mid cap and small cap, which might be slightly volatile, but your weighted beta will equally play. So this isn't just an example. You need to hedge and strategy. You can hedge with Nifty futures to your portfolio, and sometimes it might differ on the market's momentum or stock section as well. So you need to keep in those parameters as into consideration, that sometimes it might happen that some of the mid cap you are holding might be down with some bad news, but your index is not down. So you need to keep in mind such kind of scenarios. So signing off. Before I sign off, I request, in case you are liking our videos, click onto the like button and do comment how do you think our videos are or how our contents are. Signing off, Brijesh Bhatia. Thank you.